Your wealth deserves stability, expertise, security. Your wealth deserves LGT Cresto, private wealth with over a century of global heritage.
Hello and welcome to the Global View on this Thursday. I'm Andrew Gagan, good to have you with us. Well, it was all about NVIDIA overnight our time. Market in the States very much anticipating that result, and it delivered in spades. In fact, let's get across some reaction there. Dan Ives on Twitter, or X I should say, saying it's all about AI demand and use cases. The rest of tech will see this unprecedented spending wave not seen since 1995 over the coming years. But NVIDIA is on the front line and the best barometer of true spending. This is not hype. It's jaw-dropping spending happening right now. Very much a believer in what he's seeing there with NVIDIA, with questions of whether it is overvalued at these levels. But you're seeing the demand and the forecast that the company has come up with, which has very much exceeded what analysts had been expecting. And that's why you have believers such as Dan Ives there. All right, well, let's get across what's going on at a macro level. US Treasury yields sliding on weak US and European business activity data, and a possible sign that global disinflation is well and truly underway. US business activity approaching stagnation in August, with growth at its weakest since February as demand for new business in the service sector contracted. The S&P Global Flash US Composite PMI Index, which tracks manufacturing and the service sectors, fell to a reading of 50.4 from 52 in July. And the downturn in the Eurozone activity was far deeper than expected, with the bloc services industry activity falling into decline while the contraction in manufacturing output also continued. The Flash Composite PMI dropping to 47 in August from July's 48.6, reaching its lowest level since November 2020. Well, the yield on the US 10-year note fell more than 13 basis points to 4.19%, the 2-year, falling below the key 5% threshold. And the weak business activity pushed the US dollar lower against most major currencies. The Aussie, it in fact did higher than that. It rallied about 0.8% overnight to be at 64.8. Well, to get across that data and what she's seeing, how that's informing her investment decisions, I caught up with Irene Tunkel from BCA Research.
I think that what we're seeing is that US has been a two-track economy with manufacturing kind of in a slowdown or contraction, depending on how you will diagnose this, and services powering the US economy ahead. And it looks like that they are sort of recoupling, and manufacturing is perhaps picking up a bit. We may have a new restocking cycle, but the issue is that the services are likely to be slowing from here just because people are running out of excess savings. Spending on services is kind of back to pre-pandemic trend line, which means that this pent-up demand for services is exhausted. And so the question was whether manufacturing will pick up much faster than services slow down. But I think that services are slowing down before manufacturing fully rebounds. I think all of that is unsurprising because one might call it a normalization after the pandemic, or perhaps it's showing that the US consumer is weakening, especially in the light of, again, running out of excess savings and also perhaps getting close to repayment of the student loan. So perhaps knowing that, you have to tighten up your belt.
And at the same time, what are you seeing in the Eurozone at the moment? Likewise, with the service activity there falling into decline and manufacturing output also continuing to fall.
I'm a US equity strategist, but I know that Europe is much more exposed to China than the US. China is the main European trading partner, so it's not surprising that European economic growth is under pressure just because their main trading partner is really experiencing a severe economic slowdown and falling demand.
Irene, also, of course, markets very much focused on what they'll hear from Jackson Hole Symposium at the end of this week. What are the expectations for that meeting? What are we likely to hear from those central bankers?
Well, you probably will have a whole variety of opinions, but it looks like the conversation is going to be around the neutral rate of interest. What we have seen so far this year is that the Fed had put tremendous effort into tightening monetary conditions and hiking interest rates, and yet U.S. economy is still robust, it is still strong, which makes officials start thinking that perhaps the neutral rate, or the rate at which economy is neither growing or contracting, so kind of that perfect sweet spot, perhaps is much higher than they assume. Because if you think that the neutral rate is somewhere around 2%, then tightening interest rates above 2% will suggest that you are tightening monetary conditions. But if neutral rate is around 4%, then perhaps it's much higher than people expected, and implication is higher for longer. And another question that they may potentially take on, but I don't expect any resolution, is what is the target inflation rate? What is the goalpost? Is it 2% or perhaps 3%? And those in the market, and perhaps on Democratic side of the political spectrum, they're expecting that maybe 3% is okay. Why would you destroy the economy just to get to 2%? However, Chairman Powell has said many times that he wants to bring inflation back to 2%. He cannot move the goalpost because then the Fed will lose credibility. But I think that in terms of what we expect to come out of there, I think that the Fed is still concerned about inflation being stubborn, labor market being a little bit too tight, and potentially, if economy is so strong, then they're concerned about the resurgence of inflation. And so, to be honest, I think that what we will hear is pretty much, in all likelihood, repeat of the same sort of mantra: higher for longer, can't move the goalpost, 2%. And I assume that there will be lots of sort of strong academic arguments about it, because it's an academic conference. But the bottom line, I do think that the Fed is going to be committed, to bring inflation, to completely, extinguish inflation in this country.
How do you see that outlook being priced into the bond market at the moment, with particularly that US 10-year Treasury note close to those highs that we saw back at the global financial crisis?
Yeah, I think that finally the market is coming to this realization that the Fed means business, that it's really high for longer, that we have kind of a new Fed now. Because, for the past 10, 12 years, what we've seen from the Fed is, the Fed has your back, don't fight the Fed. But I think that now you still don't fight the Fed, except that you don't fight the Fed on the way up. And for a while now, people were saying, okay, well, the Fed will pivot, the Fed will, have our back, the Fed is not going to over-tighten. And now I think that they are coming to a realization that, actually rates are going to stay higher for longer. We're moving to a new interest rate regime, and actually that ties up with the title of the, Jackson Hole conference. And on top of that, we have, kind of high supply of treasuries coupled with low demand, because now not only the U.S. government is issuing treasuries, and we have, lots, QT, quantitative tightening is on the way. You also have, kind of alternatives elsewhere. You can buy German bonds, you can buy Japanese bonds, and also our relationship with China is souring, and China was one of the main sort of buyers of the U.S. Government bonds. So I think that all in all, better growth than expected, higher for longer, and high issuance of government bonds. I think that doesn't bode well for the trajectory of Treasury yields over a longer term horizon. So I think that we can sort of argue whether next move is up or down. But I think that if we think about the longer term horizon, I would expect that the U.S. economy is moving into a new interest rates regime.
Irene, let's focus on the micro. In particular, we had the result just out from NVIDIA, the chip designer, of course, a highly anticipated result. What did you make of that? What is that telling you about, I guess, the broader tech sector, in particular with that focus on AI?
Well, I think that the semiconductor sector is a funny one, because it really is the sector of sort of what I call haves and have-nots. NVIDIA and perhaps AMD are the ones that are the haves. These are the companies that provide advanced chips, especially NVIDIA, and that benefit from demand for graphic user interface chips, advanced chips that help build generative AI models. The rest of the sector is really left behind in the dust. And it almost feels that the stronger is the demand for GI chips, and the better NVIDIA is doing, and perhaps AMD, the worse it is for the rest of the companies, because their clients are reallocating budgets towards GI chips, which means that there is only one game in town. You can only buy them from NVIDIA, and again, AMD is the close second. So at the moment, blowout results of NVIDIA are not surprising, because there is lots of excitement about generative AI. But at the same time, NVIDIA is expensive. NVIDIA is expensive. There is a price for everything, and these are the big shoes that it needs to fill. Trading at 244 trailing earnings, something like close to 50 forward earnings. Price to sales, the last time I checked was also around 44. So these are all amazing numbers. But it's a question, how much and at what pace NVIDIA has to grow to actually gratify these valuations. There is no doubt that it's an amazing company, but it's a $1 trillion company. Yes, it provides strong results. It does have a backlog of orders. It benefits from generative AI, but there are limitations in the sense that someone has to make the chips. NVIDIA designs chips, it doesn't make chips, so it needs to secure enough manufacturing capacity to produce chips. It's not clear, for example, TSMC will have enough capacity. And also lots of the success on NVIDIA and what is kind of built into expectations and into valuations is down to really long sort of path of growth. So numbers are being quoted as far as 5 years out. And if you think about it, we really do not know who will be the winner 5 years out. A competitor could come out from behind, like a new startup, and they have amazing chips, and then again, NVIDIA is not the only game in town. So I'm always very sort of thinking too many years ahead. So as of now, NVIDIA has amazing results. NVIDIA is expensive. I don't know if it changes anything, except that the run of Magnificent Seven is likely to continue from here, and probably expecting bifurcation of the US equity market.
Well, I mean, you talk about just how expensive NVIDIA is. Irene, just briefly, we're almost out of time, but when you look at those growth stocks, where they've been this year, how are you viewing growth versus value at the moment?
I think that in the normal times, I would say that growth definitely should be outperforming, simply because economic growth seems to be fairly resilient. And rising interest rates on the back of this resilient growth do not bode well for growth stocks, but rather support some cyclical, cheaper names that are supposed to outperform. But the domination of the US market by the Magnificent Seven almost changes the calculus. And you can kind of be analytically very right, but at the same time, you can get this wrong, just because I would say that NVIDIA and they have some of the other plays are, I would call it a bubble. Bubbles are impossible to time, but at the same time, I think that we need to call this. And I do think that all of these Magnificent Seven are amazing companies, but they're all expensive. And at the end of the day, I think that their run will come to an end if we see interest rates going up. It's very hard to separate macro from micro, and I think at some point macro will dominate micro.
Irene Tunkel from BCA Research. That is the global view for this Thursday. Stay with us. The Open is next.